In Chapter 4, we continue our review of basic accounting, looking at using the financial statement data for analysis. Ratio analysis, the DuPont equation, the effect of improving ratios, limitations of ratio analysis, and looking at some qualitative factors. We're also continuing with DeLeon, the Florida nut people, who expanded in 2020. As reported, the results were not good, and DeLeon's board of directors and shareholders want some changes made, and quickly. DeLeon's management has taken a hard look at things and projected their best estimate for results for 2022. Starting with their projected balance sheet on the asset side. They're projecting a significantly improved cash position, while accounts receivable and inventories continue to rise. On the liabilities and equity side, more positive progress is expected. All the liability accounts decline, with DeLeon's reliance on less debt the most significant. They expect to achieve this by issuing common stock and using the proceeds to reduce debt. On the income side, sales are expected to increase along with cost of goods sold and other expenses. The big change is the bottom line. DeLeon forecasts that they can turn things around in 2022, going from a $160,000 loss to a $255,000 profit. The shareholders will definitely be happy to see the stock price recover from a dismal $225 to over $12, a significant increase over the pre-expansion price of $850. The firm is also expecting to return closer to their pre-expansion dividend payout of 22 cents a share, again making shareholders happy. Their source of funds? They issued 150,000 shares of new common stock. So why are ratios useful? The main focus of this chapter is using financial statement data for ratio analysis. They're useful for a lot of reasons. They standardize numbers and facilitate comparisons. They highlight weaknesses and strengths. They make comparisons in several directions easy, versus industry averages, versus peers or aspirant firms. DeLeon could have compared themselves to Frito-Lay, versus previous years in a trend analysis. So let's go through the list of ratios we'll be covering. 5 major categories. Liquidity. Do we have enough current assets to meet our current liabilities? Asset management. How well are we using our assets to generate sales? Debt management. Are we using debt effectively? Profitability. Are we making money? Market value. Let's look at these ratios for DeLeon and analyze our findings. Using DeLeon's forecasted data for 2022, their current ratio, 2.34. Current ratio is one of the few ratios that has a definite benchmark. Current ratio should be greater than 1. Firms should have more current assets than liabilities. Most other ratios have to be compared to something to be meaningful. Last year, another firm, an industry average. Quick ratio is basically the current ratio with inventory removed from the numerator, since inventory may not be a very liquid asset. A firm's quick ratio may well be less than 1 depending on their level of inventory. To put these ratios in context, let's compare them to DeLeon's previous years and industry averages. Their current ratio is expected to go back about where it was before the expansion, but is still below the industry average. And remember, an industry average is just that, an average, a C grade. A firm really wants to be better than average. As with the current ratio, their quick ratio is also rebounding to pre-expansion levels, but is also below the industry average. So where did the industry averages come from? There are several sources. Standard & Poor's publishes some for a fee. The most widely available is probably from RMI Associates. RMI used to be Robert Morris, but changed their name to Research Metrics. They publish averages by SIC code, categorized by firms who made a profit and all reporting firms in the SIC code, broken down by market capitalization. Inventory turnover looks at how many times a year a firm sells out all its inventory. Bigger is better. This is definitely a ratio that requires comparison, as it's highly industry specific. A grocery store would be expected to turn over its inventory many more times a year than a firm that makes large earth-moving equipment. DeLeon's inventory turnover numbers are going the wrong way. Reasons for this decline in turnover could be that they have old inventory. Now that's a serious problem for a food company, as old inventory is not sellable. They may have poor inventory control. Whatever the reason, this is an area where improvement is clearly needed. Day sales outstanding measures how long it takes to convert accounts receivable to cash. Remember, in finance, we're concerned with cash. When a firm makes a sale, it's booked to sales and to either cash or accounts receivable, depending on whether it's a cash or a credit sale. Ideally, accounts receivable are converted to cash as quickly as possible, so the smaller the DSO, the better. DeLeon's DSO of 46.44 days is probably too high, especially if the industry standard is 30-day net. DeLeon is collecting on their sales too slowly, and it's been getting worse. They were already above the industry average. They need to seriously evaluate their credit and collections policies. Both of these asset turnover ratios measure how well the firm is using its assets to generate sales. The numbers themselves are meaningless without some comparative benchmarks. Fixed asset turnover is not back to its pre-expansion level, close to 10, but it is well above the industry average. Total asset turnover, however, is declining, driven by DeLeon's heavy holdings in accounts receivable and inventory. Debt to total invested capital measures how much debt the firm is using. Note that in this ratio, debt includes both short-term notes, notes payable, and long-term debt. Total invested capital is then notes payable, long-term debt, and total equity. Times interest earned looks at whether the firm is earning enough to pay the interest on their debt. Bigger is better. Again, comparing to industry averages based on their 2022 projections and with the infusion of cash from stock sales used to retire debt, DeLeon's debt ratio has declined substantially and is well below the industry average. Their TIE for 2021 was driven by their negative net income, which they've turned around, but they're still below the industry average. Profitability ratios are fairly self-explanatory. Is the firm making money on its sales? Operating margin measures whether the firm is making money before taxes and interest are considered, EBIT to sales. Profit margin is the true bottom line, net income to sales. Basic earning power removes the effect of interest and taxes. This number is very influenced by what industry the firm is in. And here are our comparisons across time and versus the industry. Operating margin and profit margin were very bad in 2021. Operating margin is projected to improve in 2022, but it's still projected to remain below the industry average. Profit margin is expected to improve significantly, but it is still below the industry average. As the slide says, basic earning power removes the effect of taxes and debt. While DeLeon has improved, they're still well below the industry. These return metrics, return on assets, return on equity, return on invested capital, measure how well the firm is using assets and capital to generate profit and how much profit is generated for a dollar of equity. These are the ratios that would be of interest to investors. All three ratios have recovered somewhat from 2021, but they're all still well below the industry average. Note the wide variation in ROE across the 3 years. This illustrates the impact of debt leverage on ROE. Think about these two return metrics. Think of ROA as net income divided by debt plus equity. Consider the balance sheet. Holding total assets constant, if debt increases, equity declines. More debt, higher interest expense, lower net income, lower ROA. Since the numerator declined but the denominator didn't change. The effect on ROE is harder to gauge since net income declines in the numerator, equity in the denominator declines as well. There are some problems with focusing totally on ROE. ROE does not consider risk. In addition, ROE does not consider the total amount of capital invested, only equity. This has caused analysts to consider other metrics, such as MVA, EVA. Now we need market price per share for our market value ratios. DeLeon forecasted a stock price of $12.17 per share and earnings per share of $1.0231 for 2022, yielding a P/E ratio close to 12. Market to book measures the market price per share to book value per share. Like current ratio, this should be greater than 1. A market to book ratio less than 1 implies investors could buy the firm for less than book value, sell the assets at book value for a profit. Several things are wrong with that assumption. Book value says nothing about liquidation value. It's an accounting number. If market to book is less than 1, it implies that investors do not think management is doing a good job using assets to generate sales and profits. DeLeon's market to book has rebounded, but it's still below industry average. To give some intuition to these market value ratios, P/E ratio measures how much investors are willing to pay for $1 of earnings. Market to book measures how much investors are willing to pay for $1 of book value. Higher is better for both of them. P/E ratio in particular is driven by investors' perceptions of expected growth. In recent years, analysts have started focusing on another key ratio, enterprise value divided by EBITDA. This ratio looks at the relative market value of all the company's financial claims, but is not heavily influenced by the firm's debt and tax situation. Enterprise value, as shown, is the market value of equity plus the market value of debt plus the market value of any claims minus cash and equivalents. For DeLeon, the market value of equity, price per share times the shares outstanding. Market value of debt, notes payable, and long-term debt from the balance sheet. Cash and equivalents, cash. EBITDA from the income statement. The calculations for 2020, 2021, and 2022 are shown here. According to Investopedia, a value below 10 is considered healthy, but the results should be compared to industry averages and other similar firms. Clearly, 2021 was a bad year, but the firm expects to recover in 2022. We've looked at only a few basic ratios for DeLeon. Some look better, some look worse. How do we know what to focus on? The DuPont Equation, or the DuPont identity, was started by the DuPont Corporation in the 1920s as a way to break down ROE, the main focus of investors, into components to identify trouble areas. ROE is equal to net income divided by equity. In the expanded equation shown, sales and total assets cancel out, leaving the basic ROE equation. But the components break ROE down into profit margin, operating efficiency, total asset turnover, asset use efficiency, equity multiplier, debt utilization, making it easier to isolate weaknesses. Looking at DeLeon's DuPont equation over the last 3 years, 2020 was below industry average to begin with. 2021 was a disaster with a negative profit margin and high equity multiplier, high debt. Their estimate for 2022 turns things around, but their problem is in total asset turnover, too low versus industry averages and driving the ROE down. Let's take a look at the impact of improving a ratio. In this case, what if the firm could reduce their DSO? DeLeon's DSO has been well above the industry average of 32 and has trended up each year, with their 2022 estimate at 46.44. What if they could reduce it to 32? Using the firm's average sales per day, $18,905.75, reducing DSO to 32 would free up $273,016 in cash. This would add $273,000 to cash and reduce accounts payable to $605. So what could the firm do with the cash? They could repurchase stock, which is usually viewed by investors as a positive sign. They could expand. They could reduce their debt. All of those would likely have a positive effect on the stock price. Numbers are great for comparisons, but there can be problems. Comparing to industry averages is fairly easy if the firm being analyzed is in a single industry, Lowe's versus Home Depot, McDonald's versus Wendy's. What if it's a conglomerate, like General Electric, who makes light bulbs and aircraft engines? Insiders could have access to division data, but outsiders are going to see consolidated statements. Even with all firms following generally accepted accounting practice, there's quite a bit of managerial discretion as to how some numbers are handled. As we've seen, without a benchmark for comparison, it can be hard to know if a number is better or worse, if the company is a good position or a weak position. As we mentioned, industry averages are just that, average, the C level. A firm should aspire to be better than average. Seasonal factors can affect ratios. There are whole books written on window dressing techniques. Inflation can distort numbers as well. Beyond the poor numbers, some qualitative factors should be considered. Is the firm tied to a single product, pet rock, a single customer, Walmart, or a single supplier? Continual product development and improvement is critical to long-term success. Think Apple. If one customer represents too high a percentage of your sales, they control you, but they have not invested in you. It was Sears in the past, it's Walmart now. Many firms find that consolidating up and down their supply chain gives them more control. Nowadays, most firms either sell overseas or source product or raw materials overseas. This exposes firms to, at the least, exchange rate risk, as well as potential political problems overseas. Warren Buffett has said, if you've got the power to raise prices without losing business to a competitor, you've got a very good business. If you have to have a prayer session before raising the price by 10%, you've got a terrible business. What about future prospects for the firm? What about the legal and regulatory environment? Think pharmaceuticals. Heavy R&D expense coupled with strong regulations and long-term liability. All of these need to be considered along with the numbers when analyzing a firm. This ends Chapter 4 and our review of accounting.